September 14th, 2010 meeting of the Santa Barbara City Council's Finance Committee. And I begin by asking if any members of the public have public comment on a topic not on today's agenda. Seeing none, we will go on to the main event.
Thank
and
you.
Who will be speaking first? Mr.
I'll start,
Samario?
if you don't mind. Thank you, Mr. Chair and members of the committee. Bob Samario, Finance Director. And we're here to talk about two items. They're related. The Comprehensive Annual Financial Report, which we call the CAFR, for the Redevelopment Agency and then for the city. And we'll be starting with the RDA first. But I do want to, first of all, introduce Gary Caparici to my left. He is the partner of Caparici and Larson. They really have been acquired by another company. We'll talk about that. But in a moment. So he'll have a part in this presentation as well when we talk about the city's CAFR. And I also wanted to thank, who's not here, Rudy Livingston. He should, there he is. In fact, he's got a Christmas bag for us. So I would say over the last few months, Rudy Livingston, Doug Smith, and also Kim Nakamura, who were in our accounting division, they have put in countless hours in putting together these documents. And what he's handing out here are, is that the cities or RDA? Okay, this is the RDA, which we'll start with. So I just want to recognize the work that Rudy's put in over the last few months. It's just been amazing. The number of hours, I'd be embarrassed if I to tell you how many hours he's put in over the last couple of months along with his staff. So I really appreciate the work he's put into this. Another thing I wanted to point out before we get started is that what you have here is the latest draft of the redevelopment agency. As you know, last week we provided you a draft of the city's CAFR as well. We are still in production mode, and we'll talk about why there's delays. But essentially, we haven't had the opportunity to finish up the production because of delays in the audit. And so we don't expect any more changes to this document or the city's CAFR, but it is possible. It's still kind of going through a final QC review. But if there are any changes to any one of these documents, we'll be back, and we're going to recommend to council that we come back to this finance committee in January and just go item by item how it changed. But again, we don't anticipate any substantive changes at this point. It's just a matter of getting the document produced. So
okay.
And we expect that to be done by this week. So with that, I'm going to turn it over to Brian Bossi, the Redevelopment Agency Manager, and he'll talk about just briefly the RDA's CAFR, and then we'll shift over to the city.
Okay. Mr. Bossi.
Good afternoon, Mr. Chair and Finance Committee members. My name is Brian Bossi. I'm the Housing and Redevelopment Manager with the City of Santa Barbara. And as Mr. Samario indicated, I will be talking briefly about the agency's report. And it's a little different for us in the sense of this is part of our annual report. And our annual report is required by the state, and it's required to be approved by our legislative body, which in this case is the City Council. And our annual report has the State Controller's report. It also includes our comprehensive annual financial report, as well as the Housing and Community Development, the state's Housing and Community Development housing report. So what we do is we package all three of those items and a number of other smaller items together and ship that up to the state, and that relieves us of that obligation. But we do that every year. And again, going back to Mr. Samario's comments, our staff cannot thank the finance staff enough, not only now during this period of time when they're working tirelessly to get all this done, but all throughout the year. They're always available to answer our questions, and thankfully they're very easy for them to answer, but oftentimes we're not sure what they are, but they're always there to help, so we really appreciate that. So I'm just going to touch briefly on some of our projects that we've completed over the year or nearing completion. It's a good time of the year for us in the sense that we get to look back and see what has been accomplished over the year, where we're going from here on out. So it's a good time to kind of regroup and see where everything's at with the redevelopment agency. And it really is a collaborative effort. It starts here with the Finance Committee and recommendations that you then take to City Council and the agency board. And from there, it comes back to us and involves collaborative efforts with redevelopment agency staff, public works staff, waterfront staff, Parks and Rec. So all of these projects, it's not just a redevelopment agency project. There's many, many folks involved, as well as community development. So it really crosses a lot of departmental lines, which is always an interesting and exciting time. Total, we have 27 capital projects totaling a little over $30 million in our current capital program. Our annual tax increment revenue is right at the $20 million mark. And of course, we split that 80% to redevelopment agency activities or redevelopment activities and 20% to housing, affordable housing activities. As far as agency projects, I'll start with a few art-related projects. One of them that we highlight this year is the West Beach Art Program, and that was 6 different tile mosaic installations that were a part of the West Beach Pedestrian Improvement Project. I know many of you have seen those. They celebrate different aspects of the city's history, including the birth of the environmental movement, the Chumash history, Story Circle, as well as the history of the working harbor in mosaic artistic format. We also have the Storefront Art program, which was completed, and we're looking possibly to start that program up again, but that was a collaboration with the County Arts Commission where the vacant storefronts out on State Street, we would go out, the County Arts Commission would go out and find vacant storefronts, talk with owners, and then put artistic displays up in them. The idea is to kind of cover up the vacant storefronts. It's a program that you actually want to be to run itself out, because then that means that storefronts are full. And believe it or not, we have had a tough time identifying vacant storefronts. Once you get there, it may have been vacant for a while, but we find that those are in the process of being leased and tenant improvements. So it's a good thing if we can run that program out. That's what we want to do. And then there's a community arts workshop that we continue to work on. That's across the street here at 631 Garden Street. We just received a draft business plan from the Arts Collaborative, and so our staff will be reviewing that in the next couple of weeks. So it continues to move forward. That's exciting. As far as parks go, we have a number of projects. One of them that was completed this year was the integrated pest management park improvements, where park staff went out and made improvements to the parks to make them easier to maintain and be pest-free without using chemicals and things of that nature. We also have on the books a number of restroom renovation programs. Pershing Park, Pershing Park, Chase Palm Park, as well as a few other restrooms in the project area. So that's something that is not real sexy, but an important part of our waterfront and our downtown. We also have the Carrillo Recreation Center, which is nearing completion. That'll be complete in February of 2011. A wonderful rehabilitation of that very important civic building with improved space for the citizens of Santa Barbara and a number of other wonderful improvements. Downtown, we have the West Downtown improvements, which improve the Ortega and Anapamu corridors with pedestrian lighting, sidewalk replacement, and some landscaping along those 2 corridors to help people come back and forth a whole lot easier to downtown from the west side into downtown proper. We also continue to work on Plaza de la Guerra, and what we plan on doing there is we're currently looking at our pre-application review team comments as well as our historical consultant comments, trying to put those together and see how that works into the conceptual design. We plan on coming to the agency board in February to give you all an update on where we're at with that project and where we plan on going and making sure the agency's on board there. A project that was completed, I believe it's going to be complete today, is the West Side Center playground improvements. That's at the base of the footbridge coming over the 101 at Anapamu. Those are due to be complete today, so that's very exciting. Not a whole lot of park space in our west downtown area, so this is one of the few spaces available, and a good deal of improvements made there, both to the equipment as well as the infrastructure. So that'll help our residents on the west downtown. More in downtown, again, is the Fire Station number 1 renovation, as well as the EOC development, the Emergency Operations Center at Fire Station 1. Those were completed, and an opening, I believe the grand opening was held in October of last year. So that's another exciting project that's been completed. On the affordable housing side, a project that was, the grand opening was about an hour and a half ago, and that was over at 618 San Pasqual Street. That was a Habitat for Humanity project that the city participated in, 4 units of affordable housing. That's exciting. A couple of bigger projects we have on board are, one is the MOMS, or the Transition House project over here on East Coda Street. They did receive their tax credits, so our staff is working with the Transition House to make that project get up and running and start the construction process, which is due to start, I believe, in the early part of 2011. We also have directly across the street from there is the Housing Authority's Artisan Court, which, if you've driven by, is well under construction. They're due to be complete in the spring of 2011, so a very quick turnaround time, a little over a year, I'd say about 13, 14 months in construction. And that'll result in, I want to say, 55 units for downtown workers, youth aging out of foster care, as well as the homeless. So that's a big project, and I'm sure it's going to turn out beautiful like all the rest of their projects. That, in a nutshell, again, we just picked a few select projects to talk about today, and I'm happy to answer any questions you might have. But again, very collaborative efforts that starts here at the Finance Committee and the wise decisions that you folks make, as well as the agency board. And then it trickles down from there. So that's all I have for you today.
Okay. Thank you, Mr. Bossi.
Thank you.
Any questions from committee members?
No.
No questions from me either.
Do we need to move this to council? So I'll move this to city council.
I second it.
All those in favor?
Aye.
Aye.
Okay, on to the city. And I do want to point out that Rudy would normally be making this presentation, but since he was here till 11 o'clock last night, which was an early night for him, I just thought I'd give him a break. And I see that this is going to be a slow transitioning PowerPoint, but we'll get through it. So in terms of the outline today, and I'll tell you that this is the same presentation that I'll be making to council, probably in less detail, but but the same ideas, same topics. I'll start with some discussion of why there was a delay in the completion of the audit, and we'll get into some background about what a CAPR is, et cetera, looking at the layout and contents of the report so to have an understanding of how it's organized. And then we'll get into some financial highlights, real high-level stuff. And then I'll turn it over to Gary, who will talk about the audit requirements and the results of the audit. So delays in the audit. We had actually scheduled a while ago that we'd be before Finance Committee and Council on December 7th, which is typical right after Thanksgiving. I would say that in September, October, when the audit was underway, it became clear to us that there had been some changes in the audit firm in terms of what they were requiring of us and how the level of detail that they were testing and looking at and documentation that they were requiring. And that was really the beginning of what we knew was going to be a tough audit process in terms of being able to meet the scheduled deadlines. So they implemented a lot of new audit procedures, not that they were wrong, but just when you have a new corporation involved, a new company taking over an existing company, and they impose new requirements potentially and new processes that could be more oppressive or comprehensive. We also had interesting, the documents that you're going to be seeing have to undergo what's called a quality control review, and it's done by a partner. And typically that's a pretty straightforward process because they're, again, looking at high-level stuff, anything that's substantive and that would affect their opinion letter. And this year, because of the new firm involved, and Gary will talk more about that, we had a QC reviewer who was out of Florida, was not familiar with California law, and was probably a little more picky than you might expect. And so we spent quite a bit of time in the last couple of weeks just trying to address her concerns and comments and issues that she's raised in terms of how we treat certain accounting transactions. So that also caused us delay. We're now, just as of late last night, we believe, or early this morning, we've gotten her blessing, if you will, but it's the delays have caused us to be unable to actually print the document in time to have a final copy ready for you today. So I wanted just to point out that the three main issues that the QC reviewer identified, and just in terms of full disclosure and transparency, they've all been resolved. But I wanted to mention those to you because I guess theoretically it's still possible that she may have imposed other changes or changes to the CAPR as you have it today. We don't think so, but just in case, I wanted to make sure you're aware of them. And one of them is the treatment of our investment in the airport promissory note. You may recall that the airport issued a promissory note, not to the general fund, but to the city as a whole, to our treasury, if you will, that the investment that we purchased as an investment, it was a legal transaction. It's provided for in state law, government code, and also in our investment policy. So it was an appropriate transaction. But it is fairly unique to California, these types of transactions. So the reviewer in Florida didn't really see the how it could make sense that you would effectively be investing in yourself. And there was a lot of discussion about that, but in the end we were able to provide her documents that showed the basis for the transaction, the legal basis and all that. And I think as my understanding is, she's now come around. The other item is the treatment of shared costs pursuant to a joint powers authority with regard to the Cater capital improvements. You know that we have a joint JPA with Montecito and Carpinteria water districts. They share in operating costs as well as any capital improvements we make. A number of years ago, less than 10 years ago, when we made some improvements to the treatment plant, the Cater plant, funded from a loan from the state, they are responsible for a share of the repayment of that debt and essentially the investment in the facility. And the way we treated that was we booked it as a receivable from those agencies as a loan and what's called a deferred revenue. And she didn't think that was appropriate. In the end, we did make some changes, but it had no impact on the bottom line, the net assets of the water fund. But it was something that was changed. And it's not anything we did wrong. It was just sort of a different interpretation, and we said, okay, we can do that. It has no impact. And then the last item is a deficit in our FEMA fund. As you know, we've had several disasters that are being funded, at least in part, by FEMA and Cal FEMA. It just means that we spend money first, and then we get the money back. And it creates a deficit in that fund. Basically, we're spending cash, and it's being floated effectively from the other funds or the general fund. She believed that we should have some kind of a receivable since we are going to be reimbursed by FEMA. But the problem is we don't know what that amount is. It's hard to calculate how much they're going to reimburse because it's based on eligible costs, and certain costs aren't going to be eligible. We won't get 100% reimbursement. But at this point, we have no idea how much we're going to get back. And so in the end, she agreed that since it's uncertain as to what that receivable balance would be, that we didn't need to recognize any kind of receivable for that. So those are the three primary issues that really, in the last 2 weeks, caused a significant amount of delays, but they have all been resolved. We don't expect, as I said, any more changes or any additional changes to the CAFR from what we have in the final draft today. But we will come back if there are.
Okay.
So, just getting sort of into the background, and Rudy's going to hand out the final draft.
We could only get 2 copies printed before I got here, so if you wouldn't mind sharing it, we will have copies for everyone.
We'll give them both of the copies there, and we can pass them around. I'm not going to be really referring to that document in terms of page numbers. I just generally I'll be referring to sections of that document. But first I want to just start by, in terms of background, what is a CAFR? And it stands for a Comprehensive Annual Financial Report. And it's comprehensive because it includes a lot of information that is not required by state law, not required by our own city charter. But it does provide additional information that enables us to qualify for a national award issued by the Government Finance Officers Association. It's a prestigious award program. We submit for it every year, and they do impose other requirements beyond just what we consider the basic financial statements. And so we do it so we can get the award. But we believe it's also good information. You know, the statistical section in the back and the introductory section in the front, sections that aren't technically required, we believe is good stuff. And so it's for the benefit of the readers and the users of the financial statements, it's helpful. And then lastly, what we do in Santa Barbara, we want to do the best, and it's just a higher standard of excellence in producing this kind of a document. Again, it's not required. We don't have to submit for the award, but we just do it because we believe we should. And why is it prepared? Well, the city charter does require that we prepare an annual financial report that's audited by an independent CPA. It's really, it's a basic set of financial statements. We do much more than that. It also is required by state law that we issue financial statements. And we also have to do it because when we issue bonds, the bonding rating agencies require that they see some financial statements to be able to assess the financial condition of an entity, whether it be the general fund or the city as a whole, or even a particular enterprise fund that's issuing debt. So it's important and required by the bond rating agencies. And then we just think it's important because it communicates what we think is relevant and important financial information to the public about the cities. The primary focus of the CAFR, excuse me, really two focuses. One is looking at the city on an entity-wide basis or a consolidated basis. And this is actually relatively new for us. GASB Statement 34 was issued in early 2000. It became effective for us in fiscal year 2003. And it required what we call entity-wide reporting. So instead of looking at just individual funds like we've had in the past before 2003, it asked that we consolidated the city into essentially one set of financial statements, balance sheets and statement of revenues and expenses. And the point of all that was that it's prepared on a basis that's consistent with the private sector. So it's not just modified accrual or cash basis accounting, it's full accrual accounting. So when we look at these statements, the reader can really assess, unlike in the past, the financial condition of the city as a whole. It could never do that in the past. It could only sort of get a sense of how much money it had to spend, but it never could look at it and say, well, from an economic perspective, is the city in good financial condition or is it not? And so that's the focus of these statements is to show the financial condition of the city at year end, so it's a point in time, but it also reports the results of operations for the fiscal year. And so you can get a sense, are we better off than we were last year or worse off? And so you look at what our net assets were at the beginning of the year, how they changed, and have they gone up or down, and that indicates whether we are better off or worse off. And as I indicated, it does mirror the private sector reporting because they do it on a full accrual basis always. They don't have a modified accrual basis of accounting. Another area of focus is looking at individual funds, and this is what it was prior to fiscal year 2003. This is what has always been reported. We look at individual funds. For example, the governmental funds, we have the general fund is one of our general governmental funds, And the focus here, unlike the entity-wide statements, is just what's available to spend. It really looks at it from a budgetary perspective, which are annual budgets. We don't look at long-term so much or on an economic basis, just what's available to spend. And it also reports on the results of operations, the increases or decreases to fund balance or amounts available to spend. In the proprietary funds, which include the enterprise funds and ICS funds, it's the same. They've always been on a full accrual basis before 2003, so it really hasn't changed when you look at them individually, how they're accounted for. The only difference is they are kind of consolidated up to an entity-wide statement in the front. So layout and format of the CAFR, there are three key sections. The introductory section, which includes a letter of transmittal. And that's a document that is signed by both the city administrator and the finance director, and it talks about the audit process, and it gets into a little bit of sort of the economic outlook, financial results. But it's a fairly brief letter. And then we also have the GFOA award certificate, that's prior year's award, which we include. And then other information such as organization charts, city officials, etc. The main section, of course, of the CAFR is the financial section, and this is the portion that's covered by the audit opinion. And it starts with the actual opinion letter from the independent auditor saying whether the city's financial statements are materially or not materially stated. We have what's called the management's discussion and analysis. It's now required as part of Statement 34, starting in 2003. And I see it a lot like our budget message. It's a fairly lengthy narrative discussion and analysis with some tables that gives the reader theoretically or ostensibly the kind of a broader overview of the financial position of the city. What's gone on during the year is because, the document obviously isn't very user-friendly without it. It's a lot of numbers, a lot of tables, and it's really difficult to understand. And this gives the reader, ideally, a really good understanding of and an overview of the city as a whole and how we did this in past year. And then it also includes the basic financial statements, which is what in the past, or really is what's only required by city charter and state law. This section, the basic financial statements, the entity-wide statements, the individual statements, and then notes to the financial statements. And in the back, we also have what are called combining statements. It lists every single fund in the back that is sort of folded in or consolidated at higher level reporting provided in the first sections. And then the statistical section, it's not audited. It provides a lot of tables, 10-year history, some miscellaneous statistics about the city. I think it's helpful. It looks at our trends from revenues for the last 10 years and other revenues and expenditures. So it's a fairly lengthy section. Again, it's unaudited, but provides good information to the reader. So financial highlights. I apologize for the density of this slide, but this is, in summary form, our statement of net assets as of June 30, 2010. These are the entity-wide statements. So as I mentioned, they're kind of the consolidated level. And you can see that it shows the assets, the liabilities, and net assets of the city as a whole. It's broken out into really two major categories: governmental activities. It includes our general fund, the redevelopment agency, our Measure A fund, Creeks fund, and a number of other funds. It's really all those funds that are accounted for on a modified accrual basis, but it's the special revenue funds and the general fund. And then the other column is the business type activities. It's really just the enterprise funds: water, wastewater, airport, downtown parking, golf, and the waterfront. But just kind of highlighting the various categories or sections, the assets, what's interesting to see, and you'll compare this in contrast to later on when we look at the individual funds, but you can see the assets are pretty substantial, over $1 billion of assets citywide. The current assets are of $150 million in the governmental activities and $117 million in the business type activities are primarily our cash and investments. There are some other receivables in there as well. The non-current assets represent things that are not short-term, so they're beyond 1 year. And in the business type activities, the $43 million largely includes, which we classify as non-current, cash and investments that are held with bond trustees, particularly in the airport. That's the biggest source of that. They have a lot of money from the issuance of bonds that are going to be spent on expanding the terminal, and those are classified as non-current. But you can see the biggest item under assets are the capital assets. Business type activities, enterprise funds, $387.8 billion. But in the governmental activities, primarily related to the general fund, we have a fair amount of capital assets. And historically, we've never really presented these on our balance, on our financial statements. Until Statement 34, we never showed that. And which is, again, it's one, with having this in here now, it does give the reader a better sense of all the assets it owns and all the liabilities. So it's a good picture. Down below, the liabilities, the current liabilities totaling $36.7 million citywide. The non-current, which are primarily loans and bonded debt, certificates of participation and the like, $208 million citywide. And then net assets. This is, in effect, when one looks at or asks the question, what's the financial health or condition of any entity or individual or organization, it's always looking at net assets, because the person's wealth or organization's sense of, or financial condition is measured by what it owns less what it owes. All its assets minus what it owes against those assets. And the net of that is equity, or in this case, net assets. And you can see that it's a fairly large number. On the governmental activities, the net assets are almost $470 million and $381 million in the business type activities. But you can see that there are various categories of those net assets because there are different levels of liquidity, if you will, of those net assets. You can see the very first line is the amount of those net assets that are invested in capital assets. So that's sort of our portion of net assets that are represented by fixed assets, net of accumulated depreciation. It's the biggest number, biggest category. We also have net assets that are restricted for capital projects, particularly in the redevelopment agency, the $32 million. We also have restricted for specific projects, and primarily in our special revenue funds. And then lastly, the unrestricted portion in both business type and government activities. These are the portions that are, in terms of the old use of language, spendable. They're really more liquid, largely made up of reserves that are established pursuant to city policy for disasters, contingencies, and the like in capital. It also includes reserves that are in internal service funds that we have accumulated over time for capital equipment replacement and the like. But this is the number that we've talked about. You can see $115 million in the bottom right. That's the number that we've talked about a lot this past year, which was last year $116 million, so we've gone down just a little bit. But it is unrestricted, but it's not unrestricted in terms of being able to move money from one fund to another or one category to another. It's liquid money that's almost, and if you look at it from a silo perspective, every fund has some portion of unrestricted net assets, but it's restricted typically or generally speaking within that fund. This is a statement of activities. It's an unusual format, but this is what's required now under Statement 34. Again, we're looking at entity-wide statements, but this is a portion related to the governmental activities, so that first column in the previous slide. And it breaks it down, and remember, this is all government activities, not just the general fund, and you can see it breaks it down by category of expenditure. It's or function, I should say, the administration, public safety, public works, etc. And it starts with expenses in that function. And over to the right, you can see the operating revenues that are directly related to those functions. And the whole point of this is, rather than just to show what the net income is at the bottom, is to show, when you look at these functions, what's the net difference between what the expenses related to that function and what the revenues are that it brings in. So, for example, in administration, you can see it's obviously not generating a lot of revenue. Its costs are $11.2 million, and it brings in some revenue of 1.1, but its deficit, if you will, is $10 million that it has to come from some kind of subsidy, and we'll talk about that, but it's primarily taxes. Public safety, you can see that's $54.6 million citywide. 12.8 million is the revenue it generates, and therefore the subsidy that it requires is $41.8 million, and so forth. Community development down below, 20.3. On a total basis or net basis, all these government activities require about $92.7 million of subsidy, and you can see below where that difference is made up. Primarily taxes, $88.2 million make up that difference, and we know intuitively that's the case, particularly in our general fund, that taxes subsidizes a large portion of what we do. Other revenue includes interest and overhead and those kinds of things. And if you look at the administration, that number of $10 million net is really a kind of overstated or understated, depending on your perspective. A large portion of that deficit is funded through overhead, as you know, but we don't account for it within those departments like finance or administration. They recover a fair amount of those costs from enterprise funds. So that's in the other line below of $11.3 million. But you can see on a net basis at the bottom that the net assets actually improves citywide within the governmental activities funds by $6.9 million. Our net assets at the beginning of the year were $463 million. They've gone up by $6.9 million. So essentially the question is the city, in terms of the governmental activities, better off this year than it was last year? The answer is yes. Our financial position, our condition has improved by 6.9%. Looking at the business activities, same format, except we just break it down by enterprise fund. You can see that some of the funds have actually had an operating loss. Those losses netted $758,000, but they were made up by the interest income below, $2.6 million, which is not considered an operating revenue. So they still had a positive change in net assets of about $3.4 million, which added to their net assets at the beginning of the year. So they, too, on the whole, are better off this year than they were last year, even though some individual funds, like the golf course, even when you factor in interest or income, still recognize a loss this past year. So now we're looking at the individual funds. It's just we're going to really focus on the general fund. This is their balance sheet. And I'm not going to go through the details of this, but I wanted to show you that if you look at the assets, what you'll see just conspicuous by omission is the fact that we don't have any long-term assets or fixed assets in there. This is how the old level reporting that we still are required to do. So we show no long-term assets, nor do we show any long-term debt associated with this fund. And this is the case with all of our governmental funds. So when you look at the net asset number below, which is what we call fund balance of $24.6 million, it's not a measure of its financial condition as of June 30. It's just measuring how much money is available to appropriate next year. That's really all it is, because everything you see there in terms of assets are current assets, and they're all current liabilities. And anything that is long-term in nature, like we might have a loans receivable up at $4.2 million, that's included down below under the fund balance reserved. It's within the $5.6 million because we don't consider that available for spending. Only the portions that are really either in cash or will become cash within the next year are considered a part of our unreserved, undesignated fund balance, but a different focus, if you will, in terms of what it's trying to measure. And that's the $19 million, you know that's the number that represents our reserve policies. Primarily is the disaster reserve, but a little bit of our reserves for economic uncertainties and our capital reserve. General fund revenues, you can see the first column is the annual budget. This is the amended budget and our actual revenues and then the variance. I do want to point out that this does represent the amended budget, which means that it reflects the $2.5 million that we lowered our tax revenues back in November when we first started recognizing that our revenues are really going even further south than we anticipated. In terms of the taxes, on a net basis, we are still, even after we made those adjustments, we came in under budget by about $563,000 at the end of the year. You can see the biggest variances were in sales taxes and property taxes. Under the next category, we were also about $1.6 million below budget, but most of that came from the intergovernmental category. That's the mutual aid. You remember we talked about this before, where we budgeted a fair amount of revenue in responding to mutual aid. We budgeted costs as well as revenues. We didn't realize those revenues, nor did we incur those costs. And then down below, the budgeted year-end variance, the infamous thing we budget every year. We anticipated when we first developed the budget some year-end variance. We did recognize that on the expenditure side, nothing on the revenue side, but it doesn't show as an actual number because it just comes from savings on our expenditures, which we did realize. But in total, you can see that we're under budget by about $3.6 million. On an expenditure basis, as you know, we were well below the budget by the end of the year. This was a concerted effort on all departments to try to reduce spending as much as possible. And in the end, we did. We were able to come in under budget by almost $4.4 million, which is a significant variance, really unprecedented, which was done, again, in part to help balance the budget by the end of the year so we didn't have to use reserves. Looking at sort of a summary, focusing on the middle column of actual amounts, we had revenues of $100.7 million, expenditures of $100.3, and we actually ended the year with a slight surplus of $422,000, which will add to our reserves for economic uncertainty. At the beginning of the year, we had fund balances of $24.2 and ended $25.3. I'm going to speak to two footnotes that I think are important. We always talk about our PERS footnote. It's footnote 9 in the document you have in front of you. And this is designed to present to you a number of things, but what's essentially the funding status of our retirement plan, broken down by the three plans that we have for miscellaneous, safety, and fire and safety police. And I'll start by just kind of helping to understand the columns. You can see the fiscal year is 2010. That's the year of the audit or the year of the financial statements. But the valuation date that is developed at this data was done as of June 30, 2007. So it's 3 years old. So, which means that it doesn't reflect what happened in 2009 or 10, and we know what PERS realized a substantial loss in its assets. So this is as of June 30, 2007, these numbers. So the accrued liability, when you think about a pension plan, it has a sort of it's designed to over time accumulate enough resources to pay out the benefits by the time an individual retires. And the accrued liability represents the amount that we should have along that funding line or curve in the bank in order to pay off those benefits. So and you can see from the miscellaneous plan, almost $300 million is what we should have in the bank based on our plan and all the assumptions that are made in terms of investment returns and the date of retirements and so forth. And for the safety fire plan, we should have $115 million and then $146 million for the police. This column represents what we actually have in assets. This is the value of the assets as of June 30, 2007 that are there to fund those accrued liabilities. And you can see that in the next column that we are underfunded, if you will. And that's the unfunded liability. It's the difference between what we should have in the bank and what we actually have in the bank. And these aren't inconsequential numbers. It's, in total they're about, $90 million. And this is as of June 30, 2007. So again, it does not reflect anything since then. And is in about 3 years, and we've hopefully sooner than that, if we were to show you the same schedule, which is based on June 30, 2009 or 10, the numbers will be substantially different. You'll see that the unfunded liability is, and I'm not even sure what it's going to be, but it's going to be a lot more than $90 million. And so and this is, again, all disclosed in our footnotes. The funding status is that for the miscellaneous plan, we are 80.9% funded, 83% for the fire, and 82.7% for police. And at that time, that's pretty reasonable. It's unusual. It just depends on variations, I guess, in the early or the late 90s. Before the recession of 2001, I would bet that we were close to 90%. In fact, probably overfunded in some cases, was why we had zero PERS rates. But 80%, 81 is not too bad. It's not, out of the range of what's reasonable. No problem is it's just gotten worse in the last few years. The disclosure also includes the annual covered payroll, and this is important because it gives you a sense of the magnitude of the liability relative to the amount of money we pay each year in payroll, and therefore that's the source of funding of these rates. And so to the right, you can see that the unfunded liability represents on the miscellaneous plan 117% of the annual covered payroll, whereas you look at the fire plan is 206%. And this is an important measure because it tells you how essentially gives you a sense of the volatility of the PERS rates that will have to be adjusted in order to fund changes in the assets. So when we have major asset losses, there is going to be a disproportionate impact on the fire and police rates than there will be in the miscellaneous plan because they have fewer dollars to work with, and the ratios are different. And I'm not sure that makes sense, but so it gives you a sense that the same equal losses and assets, the impact on rates are going to be greater in the fire and police than they are in miscellaneous. They're still going to go up, but substantially more in proportion because of the fewer dollars that are available. Okay, so now we talked about PERS, which is a retirement benefit, but there are other retirement benefits that the city of Santa Barbara offers and other cities do as well. And this is a relatively new disclosure pursuant to GASB Statement 45. It became effective just a few years ago, 3 years or so ago. And this is presented in footnote 16. And you can see the numbers are pretty substantial, but I'm going to go through each one because there are three components to this, what we call other post-employment benefits, or OPEBs. The first is we call the retiree medical, and all three of these, by the way, we have an evaluation done just like we have for PERS. We have to hire somebody to do so, but they give us evaluation, in this case, as of July 1, 2009. The first is retiree medical. We provide a benefit that's pursuant to MOU to employees who meet certain criteria. They have to first work with the city 15 years, and they also have to retire with the city. And based on the bargaining unit, they will receive a monthly stipend that is for helping them pay for their insurance benefits, because once they leave the city, they're going to be on their own for paying them. And it varies, but it ranges somewhere from between $10 and $15 per month that they pay for every year of service. So it could be a big number, but it really has a cap on it. It maxes out at about $350 per month, and it's only paid up into the age of 65. So once they retire, let's say they retire at 55, they will be provided this benefit till the age 65 until when Medicare kicks in, and then they're on their own. A lot of cities have provided or do provide lifetime retirement medical benefits, whether it's $300 or maybe just no limit based on whatever they're paying. And their liability is substantial, just substantial. For us, it's fairly small, relatively small, because again, it's capped both in terms of dollar amounts, and it's also capped in terms of when they up to the age of 65. But you can see that the actuarial accrued liability as of July 1, 2009 is $8.4 million. You see, we have no assets. We're not funding any of this. We're kind of handling it on a pay-as-you-go basis. And at some point in time in the near future, we'll be talking about with the City Council and Finance Committee about a plan for helping to start funding some of these liabilities, because we aren't, unlike PERS, which we fund every year. We pay money into it. We're not paying any money into these liabilities. The second is implied subsidy, and this is a little more obscure or abstract because, and there was a lot of debate at the GASB level about whether we should even be including this or not, but it represents the benefit that's being provided to our retirees who are able to participate in our city's group insurance plan. And they get basically a preferential premium because if they were separately rated as a group, the retirees are older and, of course, have more medical issues, their premiums would be in the order of 20-30% higher than what they are. They pay the exact same premium. It's a blended rate as what I pay, as what if somebody who comes into the city at age 25, they pay the exact same premiums for whatever choice they make in terms of the health plan. So there's an implied subsidy, because if it weren't for the fact that they were able to participate, they would be paying more, and city employees who are active would be paying less. And so that represents a liability we are now required to disclose, and it's something that we provide to our benefit to our retirees once they retire. And not everybody participates, because if they don't retire with the city, they don't enjoy the provision, and they don't have to choose it, but most do, and once they retire. But that liability for the implied subsidy is a big number. It's $22.3 million, because it doesn't just include the current retirees. It makes projections about active employees and what's the likelihood that they will retire with the city, and what will be the insurance premiums back at that point. So there's a lot of assumptions, but it's a big number. And in some communities, it's a much larger number. It's $100 million, just because of the amount of just the differential. We also have, as you may know, sick leave benefits. Somebody retires, they have part of their sick leave hours that they've accumulated at best, and they can turn that into just a cash payment, a lump sum distribution, or they can convert it into an annuity. And for public safety, they can actually include that and add it to their service credit, and under those same calculations, so they get an annuity effectively. But it is the liability that the city has, and it's $3.8 million. As of July 1, 2009. So you can see in total we have an actual accrued liability of $34.5 million. It's only disclosed in our footnote. It's not presented, at least most of it is not presented in our financial statements. What GASB has said is that you don't have to include this in the face of your financial statements because obviously it's a big number. As long as you're paying what is called the annual required contribution, or an ARC, our consultants have provided us a number that says if you were to pay this every year, just like with PERS, your contribution requirement, you'll be able to fund this liability over time, and you will be fine. But GASB has said that if you aren't making any contributions, that the amount that you don't make in any given year has to actually be booked as a liability on the face of your financial statements, and which we are doing for the last several years because we are on a pay-as-you-go basis. The portion that's short of the annual required contribution, we are booking as a liability on our books. If we never fund this, ultimately we will have a number on our financial statements citywide as a liability of $34.5 million. So it's a big number. And so that's why I said earlier that we will come to council with a plan soon about how we start paying this and we wanted to do this a few years ago, but obviously the economy kind of went sideways and it was just not the right time to add money to this liability or to fund these liabilities. Yes.
Mario, one thing. The retiree medical benefits, is every city employee eligible for that?
Every city employee is eligible, but again, they have to meet the requirements that they have to be with the city for 15 years just to vest, and then they have to retire with the city in order to get those benefits.
Okay, thank you.
It's different than each of them.
Yep.
Okay.
Okay. So with that, I'm going to turn it over to Gary Caparici, who will talk about the audit requirements and results.
Thank you. Mr. Caparici.
Thank you very much. Welcome, Chair and members of the Finance Committee. Some audit requirements, and just to build up on what Bod said, this last year on March 1st, just to give you a chronology, we merged with a firm after I did about a year and a quarter of negotiations with them, and joined them on March 1. Well, lo and behold, as of October 1, they merged with a national firm back east. That changed and threw in the quality control that Bob gave you a discussion about, and that threw us, as of just a month and a half ago, that threw us like, oh my gosh, how are we going to get through this? So we've been paying the pains as Rudy's working every night to, was it 4 in the morning once, Rudy? Wow. And on our side, we're matching up too. So we're right with Bob to try to get this done. Let's see, some of the objectives of the audit that we have, 2 things, and I certainly won't read all of this. But the first thing is to give an opinion on the financial statements in conformity with generally accepted accounting principles, or GAAP as it's called. And secondly, we review and evaluate internal control. An important element in that second line is internal control over financial statements that we're talking about, but at the same time, we have separate internal control review of compliance matters. And we'll talk about that a little bit later too. Whereas the city's responsibilities are responsible for the financial statements, of course, responsible for establishing and maintaining these internal controls over both compliance and the financial statements. They provide all the financial records to us during our audit, and they provide to design and implement programs over fraud, particularly. And anytime you have any questions, please stop me, because I'll just go right through these slides pretty fast. Our audit approach is a 4-phased approach. Back in May, we did our internal control work, our planning and plan for the internal control, which we came out in May to do our risk assessment of the city's internal controls. And finally, this last one is we come out in September and October to validate the accounts and the balances and look at the disclosures in your CAFR. We review those very carefully, and then, of course, we work diligently with the city on the financial reporting side that you're looking at. Okay. Our audit opinion for the city, as it has been for the last 4 years, is the city received an unqualified report. We believe that it fairly presents, in all material respects, the financial position and results of operations of the city of Santa Barbara. Some other matters that we follow as a practice in auditing is we meet with the chair of the Finance Committee to review how the audit is going, any difficulties found, any trouble spots, get basically a heads up. During the year, we've had no disagreements with city management whatsoever. We've found no material weaknesses or significant deficiencies in internal controls. We've had no indications of fraud or inappropriate activities. We have no findings or question costs. That's as good as we can give that, by the way, just for your own information. Two things this year. I selected just two. There were 6 new standards put out. These two relate. SAS number 115 on communicating internal control related matters identified in an audit. That's what everybody used to call years ago the management letter. But this clearly identifies material weaknesses and significant deficiencies. The city has none of those. The second one I hinted earlier was SAS number 117 on compliance audits. This added the requirement immediately. There wasn't a transition period. It says this is effective immediately, that we now need to do, and we have done, separate internal control documentation, evaluation for compliance matters, in addition to separate controls, separate testing for both of them, relevant to the financials. So we're doing 2 sets this year. That added about, my guess is 100 to 125 hours of the audit, into the audit. This is an important element, but notice it says in the top, it's in process. GASB has a due process that's very good and very, very followed. 4 steps. They go through what they call an invitation to comment. They go through a preliminary review. They go through an exposure draft, and then they issue the standard. This case here, this is on pension plans, accounting, and financial reporting. You noticed as Bob went through all the financial statements, then he discussed in footnote number 9 on pensions and footnote 16 on other post-employment benefits. None of those numbers were in those entity-wide financial statements. So as you look at your liabilities, you're saying none of that is there. No. The only case was the OPEB, the ARC, and that's relatively small compared to the total. Well, GASB finally, about a little over a year ago, designed a project to say, let's look at pension accounting again. And they determined, and don't laugh, but this is true, after a vote of 7-0, that actually pension is a liability for the organization. Whereas 10 years before that, their vote was it is not. Very, very clearly. So, given that, they've now gone through this first 2 steps, and on the preliminary review step, they actually hold public hearings across the United States. And they held one in San Francisco, and I'll talk about my recommendations on the next chapter. This one here, some of their recommendations are very clear. Whoops, where is it? It gets small, my eyes are like getting, as Bob knows. Some of the key discussion points were to talk about booking this as a liability. Second point was to use only one actuarial method, where in the original pension documents there were 6 different methods allowed. Now we're going to go to one that's the predominant one being used in the country anyway. Next item's a big item. When the first pension plan, GASB 27, was passed, they allowed amortization for prior service costs to go up to 40 years. Now they're saying, oh, that's probably a little out of line. Now they're talking about service lives, which generally go from the estimates I hear 11 to 15 years. That's a serious increase. They're going to look at smoothing. They're actually looking at smoothing methodology when unusual market movements happen, like we've had in the past couple of years. Smoothing meaning to straighten out, to lengthen it out, to give the entities a little break and not have to pay it all tomorrow. And they're looking at actuarial evaluations at least every 2 years, biannually. And my comments on this were in San Francisco, and this was in October of this year, where we need the actuarial evaluations or actuarial updates to be actually current, probably on an annual basis. The numbers are too large to be, as Bob pointed out, 3 years old, right? Not very good. Secondly, we mentioned that maybe the auditors, these numbers are going to be the largest liabilities that any of the agencies or cities have or counties have in the state. We may have to hire our own independent actuaries to review the actuarials as well. And the third point we made is, and FERS doesn't like this comment, but get that current information on their actuarial studies. And the last comment I made was we should not forget about the other post-employment benefits. If you're going to implement pensions over the next 3 or 4 years, don't add 3 or 4 years before you add OPEB, was our suggestion, is take a look at implementing that at the same time.
If I could just add, if the GASB requires that we book as a liability within the financial statements, the unfunded liability of our PERS and OPEBs, it will just completely turn the city upside down. I'm assuming that the $90 million we have now may grow to $150 million in the next year or so.
At present value.
Present
At
value.
present value.
Our overall budget citywide is about $250 million. Operations about $200 million. So it's a big, big number, and I just can't imagine they're going to require that we have to book the unfunded liability. But that's what they're talking about because they're trying to move toward a more full disclosure of what the true financial position of an agency is.
Yeah, but realize they're on phase 3. So it's not into it's not into the books until the standard's issued. So they're going to go through that process probably throughout 2011.
Interesting.
So that concludes our presentation. I'd be happy to answer any questions.
Thank you. Any questions from committee members?
Yes.
Ms. Self.
Thank you, Chair Francisco. On the unrestricted funds in the general fund, because that became sort of an issue with some of our bargaining units, can you do a breakdown at council to show, so much is in the disaster fund required, and what that amount is, and whether it's, I don't know, it's not required by charter, is it? Is it?
No, that's
It's just a policy.
Council policy.
Right.
And I can tell you, the $19 million that I mentioned, it's about $16 million for disasters, $2 million for economic uncertainties, and $1 million for capital, roughly.
Okay, and so if you would
Sure.
kind of bring that up.
There's
so.
also a footnote in the CAFR that goes through that. I think it's note 13, but I could look at that real quick, but it's in there, and we can highlight that.
And then with the full-time equivalent city employees, I'm assuming that community services would include parks, recreation, library.
That is correct. That is
Okay.
correct.
Thank you.
I'm sorry, it wasn't note 13, it's actually note 10.
Okay.
So it's in there. And we once again, I apologize for not having copies for everyone, but my staff is actually in the process of printing them and binding them as we are sitting here, and we will have copies for every one of the council members before the council meeting begins today.
We appreciate this just-in-time production.
Who says you
holiday
can't run
reading.
a business? Yeah. No, I just think it'll be interesting to see what GASB. I mean, the ruling is with PERS, because how that then relates to our budgeting process and real money versus money that's unfunded but not something you have to pay out for decades.
We
in some
will
case.
follow
So,
that. I will follow
yeah.
that through this process.
And trying to
Believe me,
explain that
keep
to
you-
the general
keep you
public too
informed.
is going to be really difficult. But it is obviously an issue we need to attend to, because those are funds over time that we'll be responsible in paying somehow, but just not next year.
Right.
Right. So, right, as I understand it, right, the unfunded, it's the same way as saying if everyone should retire tomorrow, and what then we would have to be
Correct.
required to
That's
pay
correct.
out, which is just not going to happen. So we want to put a little realism
Right.
into the process here.
Right.
But
Agreed.
thank you for the report.
Okay. If there's no other questions or comments,
I'll move this to the council agenda.
all those in favor?
Aye.
Aye. And with that, the meeting is adjourned.
Thank you very much.
Thank you.